Hello everyone, and welcome to Virginia International University's MBA 610 Business Taxation session. Today we're going to be looking at a couple of examples to help clarify this idea of deduction sequencing. And so you may recall when we talk about deductions, we're talking about examples such as the charitable contribution deduction or the qualified production activities deduction, or the dividends received deduction, or the net operating loss deduction. And as we talked in an earlier class, there's a particular sequence to the calculation of these deductions so that we end up with a calculation or an amount that we can then apply to our limitation provisions surrounding the deduction. And so it's important as we're walking through the examples to understand, what's the sequence of how these deductions are used and calculated to get to certain adjusted taxable income amounts. So let's first look at an example of just how we calculate taxable income. And so in this example, we see Hale Corporation. And Hale Corporation reports gross income from operations of $300,000. They also received dividends from a 15% owned domestic corporation of $100,000. And the key here is that the amount of the ownership, and in this case it's 15%, and the domestic corporation, the nature of that corporation is that it's domestic and not foreign, because as we talked in an earlier session, if it had been foreign, there would be no dividends received deduction allowed at all. Then we also keep in mind that it's 15% owned, and the reason that's important is, and during this pause, you all should have been thinking through your mind, I hope, that, well, we talked that the dividends received deductions is 70%. If it's less than or equal to 20% owned, it's 80%. If it's greater than or equal to 20 or greater than 20%, but less than or equal to 80%. And there's no deduction allowed if the ownership is greater than 80%. So that's why, we want to, these facts around the question or the example, such as 15% owned and a domestic corporation, are important. So anyway, that's $100,000 they received, and then they had operating expenses of $280,000. We're told that gross income from operations and expenses both pertain to qualified production activities. And we talked earlier in the class, if you recall, about, well, what constitutes qualified production activities? And so in this case, we're given that. And so we calculate the qualified production activities income as gross income less operating expenses. So we get to that very easily by simply taking the gross income from operations of $300,000 minus our total operating expenses of $280,000 to get us to $20,000. We also know that because it's a 15% owned domestic corporation, that there's a 70% dividends received deduction, except or unless there are limitations. There's a 70% dividends received deduction of $70,000 available. So using this information, we can calculate the taxable income as follows. Their gross income, now remember, gross income, so it's income from all sources, is $400,000. That's the $300,000 in income from operations plus the $100,000 in dividends received. So their gross income is $400,000 less the operating expenses of $280,000 gets us the taxable income before special deductions. So we know that we are given that they're 15% owned, that it's not a foreign corporation, it's a domestic corporation, and that we're not in an operating loss position. So we know that we can deduct the 70% dividends received deductions of $70,000, which gets us to taxable income before the U.S. production activities deduction. So again, we're not in an operating loss situation, so we're able to deduct the U.S. production activities deduction of calculated as 9% of the qualified production activities income we had previously calculated of $20,000. So that 0.9%, that 0.09, or the 9% times the $20,000 gets us to an $1,800 deduction from the $50,000 and of taxable income before the U.S. production activities deduction, which gets us to a taxable income then of $48,200 in this example. So take a few minutes to look at that and look back at your slides and your notes to understand why each of these taxable income amounts before special deductions, before the U.S. production activities deductions, why each of these taxable income amounts did not prevent us from being able to take these various deductions. So now let's walk through an example where a limitation may exist and we're not able to take a deduction. So let's suppose instead that Hale's operating expenses are $310,000 in this example, not $280,000. So in this case, where we have income, qualified income of $300,000, qualified production activities income of $300,000, less the $310,000 in operating expenses, we have a loss situation, right? We got a $10,000 loss. So in that case, no U.S. production activities deduction is allowed. So knowing that, then, we see that Hale's taxable income before the dividends received deduction, same calculation as earlier, it's the $300,000 in qualified production income plus the $100,000 in dividends received minus the $310,000 in operating expense gets us to $90,000. So here we know that the dividends received deduction is limited to the lesser of either 70% of the dividends received or 70% of taxable income before the dividends received deduction. So if we look at item 1, we see that $100,000 times 0.7 is equal to $70,000. That's the deduction allowed under item 1. Under item 2, we would look at the taxable income before the dividend received deductions, which is $90,000 times the 70%, which gets us to $63,000. So the dividends received deduction is the lesser of those two, which is $63,000. So then Hale's taxable income under this scenario becomes $90,000 of taxable income before the dividends received deduction less the qualified or limited amount of the dividends received deduction we're able to take of $63,000, getting us to a $27,000 taxable income. And so again, this is just a very good example of showing, what are some of the limitations to some of these deductions and how do they apply. In this case, we had a net operating loss resulting from U.S. production activities income and operations. We had a loss of $300,000 in income minus $310,000 in operating expenses of $10,000. So no production activities deduction is allowed. So then we move on to calculate our taxable income before the dividends received deduction. And again, we're using the same numbers except for operating expenses, and that gets us to $90,000 of taxable income before the dividends received deduction. We know the dividends received deduction has these two limitations. It's limited to the lesser of either 70% of the dividends received or 70% of the taxable income before the dividends received deductions. And that's where the calculation of 1 and 2 on this example gets us to a dividends received deductions of less than 70% of the dividends received or $63,000, which once we reduce our taxable income before the dividends received deduction by that amount, it gets us to a $27,000 taxable income. So take a few minutes and look at these amounts and just kind of make sure you understand, again, it's just the application of certain of the limitations and calculations to our problems. And so in this example, we're going to walk through a little bit more of a complicated, complex case that really kind of shows, again, the importance of this sequencing and how it works. And in this example, we're going to be talking about charitable contribution deductions. We're going to be talking about net operating loss carryovers, dividends received deductions, and then the U.S. production activities deduction. So in this case, we are given that the gross income from operations is $150,000. We're given that the dividends received from a 30% owned domestic corporation is $100,000. Our operating expenses are $100,000, and the charitable contributions made by C Corporation are $35,000. So we're also to assume that these are qualified operations or production activities, and so that tells us that we have the $150,000 in income from operations reduced by the $100,000 in operating expenses to get to $50,000 of qualified production income in the current year. So we also are told that to further assume that C Corporation has a $40,000 net operating loss carryover from the previous year. So first we have to calculate the charitable contribution deduction to understand whether there are any limitations on that. So we start with gross income from operations, which is the $150,000. We add to that our dividends of $100,000 to get $250,000 gross income. We reduce that gross income by the operating expenses that we're told of $100,000 and the net operating loss carryover of $40,000. So you recall from earlier discussions that we're limited to a 10% amount, 10% of the adjusted taxable income base with respect to charitable contributions. So we've calculated a base here of $110,000. We multiply that by our 10% to see that for this year we have a charitable contribution limitation of $11,000. So that's all we can deduct this year. The limitation means that the C Corporation has a $24,000 excess contribution that carries over for 5 years. And that's just simply the amount of the contribution we made this year less the amount we're able to take, constrained by the limitations, but the amount that we're able to take this year of $11,000. So we have $24,000 that we can carry forward for 5 years. If we don't use them by those 5 years, then they expire and we lose the use of them. So then we get into calculating the taxable income for C Corporation, and we calculate that by first taking our gross income from operations, which we were given above of $250,000, reduce our operating expenses of $100,000, and then we reduce it by the amount of our charitable contributions that we're able to claim this year of $11,000. So this gets us to taxable income before these other special deductions, which include the dividends received deduction of $80,000, because you'll recall we have a 30% ownership in this domestic corporation, so that gets us an 80% dividends received deduction, and we reduce that by the amount of our net operating loss carryover. And so once we've done this, we get our taxable income before the U.S. production activities deduction, and we understand that that's limited by this taxable income base, and it's limited to 9% of that. So from the taxable income base of $19,000, we deduct $1,710, which is the amount that we're allowed to deduct, 9% times $19,000 for production activities deduction, and that gets us to a taxable income in this example and case of $17,290. So take a little time and look at this, and maybe go back to your notes to make sure you understand some of the limitations around all of these deductions, and that when we factor those limitations into this example, you can understand where it's coming from. And I appreciate your attention to this. I hope it was helpful, and let me know if there are any questions in the next class session when we meet. Thanks very much.